Hey traders, Nick Shaheen here, looking at earnings for banks. Every quarter I do one of these videos, or I try to, just because it's such a particular situation. It's so clear on how to play the earnings. Now, before I start anything, recap on the day, an up day about 1.5%, let's call it 1.3%. We've had a few dips. We've yet to know if we're going to fade into the close. I favor not, because of the fact that we don't have anything scheduled tonight other than the fear from Facebook, so maybe that'll drive us down. We had a few headlines that caused dips today from the highs, and there's an air of bearishness in the market. I will bet against that, meaning I think that not having a major like China-US tariff thing going on overnight, we're not going to sell into the close to the effect that we did yesterday and Friday. So having said that aside, back to the earnings. Again, earnings in general, the short-term reaction on earnings is a complete coin flip. What does that mean? Even if the company gives me the P&L, I couldn't tell you how the market will react, because I don't know the questions they're going to ask in the conference calls. I don't know what they're going to say in the conference calls. I don't know what the people expect. So I've seen great reports get sold off 20%. I've seen crap reports get bought up 10%. So that aside, there's a way to play the timing with earnings. So XLF, the easiest way is XLF is the major. It's an ETF that tracks financials. And I can throw a trade in the XLF, bearish or bullish, depends on my thesis, and call it, I'll throw it this week into Friday earnings and say I'm going to hold it for a week, for next week. So I would use May contract, maybe May 4th, not any shorter than this. This way I have time on my side. Okay, so the most aggressive way of doing it, buying puts or calls. Because it's not hedged, I'm picking a direction. Less aggressive way would be debit put spreads or debit call spreads. Depends on my thesis. We'll get into that in a second. More aggressive, or differently I should say, credit put spreads or credit call spreads. I will never recommend a credit call spread in something this volatile or valuable. In other words, the value is there. Stocks should not sell on valuation. They should sell on, if they sell, it will be on expectations, not on actual valuations. We'll get into that in a second. Okay, so I'm long, caveat, I have been, as I've been saying here over and over, I've been long Bank of America calls, which are really, really green. I may trim into the earnings. I sold puts in Bank of America to buy those calls, so I'm really long for free. I'm also long XLF calls, which are really, really green, and I've been sharing, updating, and I may trim some of those or sell some calls against them. Not shorting, just hedging. Okay. Having said that, I still think banks are cheap. So here's the thing. Timing is important. It all starts this week with Wells Fargo, JP Morgan, which is the cream of the crop, or so is perception, and Citigroup, all of which are a buy in my opinion. So Wells Fargo would probably be the worst one from a fundamental perspective, just because it has issues all by itself. So, but technically I do like Wells Fargo because it has a lot of upside potential. Now, red and blue is just a simple regression line. Nothing more, nothing less. Okay, so having said that, reverting to the mean shows a lot of upside. All right, JP Morgan, just to look at it, still has the same upside. They had a few red candles here, which are pretty strange. Rates are rising, so that was falling rate stays on exploding TLT, I believe. But regardless, all of which are not expensive. Let's look at the PE of JP Morgan. I haven't looked at it in a while, but I bet you it's pretty low in absolute terms. 16 PE trailing, so that's actual PE. Price to book 1.6, 1.7. They're cheap, not as cheap as they were, but they're cheap. So do I trade these stocks? I like to trade the stocks that will report next week. So instead of playing these stocks, I would like to play Bank of America. Why? Or Goldman. Goldman or Bank of America don't report until next week, so they will move in sympathy. So it's a quasi-long these stocks that are reporting this week via next week. Why would I want to do that? Let's say I bought calls in JP Morgan, and they report, and for some reason the stock falls. So those call premiums will die and disappear completely. Okay, and I lost my money. But if I bought calls in Bank of America or Goldman in anticipation, the Goldman Sachs stock will also fall, but first of all, not to the extent as JP would fall on the event. And second of all, its premiums will hold up because its own event, Goldman Sachs' event or Bank of America's event, is still yet to come. So yes, my calls will lose some premium, but they will live to fight another day. So it's kind of like getting a free look at Goldman Sachs and Bank of America, to name two. There are plenty of other ones. Lottery tickets. So if I buy a lottery call ticket or put ticket in Bank of America or Goldman Sachs for next week, then if this stock here that reports this week falls or rallies, my premiums either will benefit along with it or will lose a lot less. So it's a win-lose-less situation versus a win-lose situation. Okay? That's why I like to play the timing thing. And that's the point of this video. Be smart about the timing. Now, I could, draw a line in the sand on Wells Fargo and say, this thing is going to rip to high heaven. I'm going to buy calls in Wells Fargo, and I'm going to hold the line in Wells Fargo. That's fine. The benefit will be a lot bigger than a sympathy move in Bank of America. But, risk-reward thing. You're risking a lot more to gain a lot more, or risking a lot less to gain a little bit less, if that makes sense. So this is personal preference. If you know something about Wells Fargo, then go with the Wells Fargo calls or puts, by all means. I think Wells Fargo has seen some disastrous headlines, and they still can't, break the bottoms. So let's zoom out a little bit on a weekly for Wells. This is a well-consolidated zone, which should provide some support on top of really hideous headlines, on top of its own headlines. So, hey, upside potential is there, and I haven't checked the metrics on it. Bear with me. Where are we? Oh, 14 and 1.5. So thereabouts the same. I do like it. So it's not bloated. It's pretty cheap in absolute terms. In relative terms, it's priced in line. Citigroup, also well managed. They were calling for $100 shares not too long ago. So those people will go back and chase it. I think they will. And I think they had a headline of sorts recently which surprised me, so that's extra juice. So Citigroup, 12, almost 13, trailing 12 months, under 1 price to book, under 1. So they don't even give it credit for what it owns right now as a stock. That's crazy. So I'm not long Citigroup. I'll probably go long Citigroup against my own advice. So that's the concept. Play next week's earnings via this week. Sympathy moves. So, or you can just play it one for one like I just did. I like Citigroup, so I may go long Citigroup a little bit, but I'll probably trim some of the other profits. This way I'm not too one-sided. Okay, so this is the concept. Oh, by the way, this is a weekly chart. I know this is the daily, the upside potential reversion to the short-term mean. This is just a simple regression line, and it just depends on the timing you're looking at. So this, I can tell you that this is an important level for Citigroup because it was right here. I'll draw it all the way. Right here was resistance, let's call it, and then breakout, and then support, and then support. You can argue support twice here on a double bottom-ish, and then support, and then break down. Back to it. Is it going to be forward resistance or another opportunity? Whoops. Another opportunity to regain it. So it is important. And the trend line, you can see it. Whoa, bad. Trend line, they all meet here. So there's a confluence of decisions to be made here. Usually they're explosive. So you think it's worthy to fall like this or break out like that. I favor the upside. This is a simple, silly way of looking at things. Crayon style. It's cheap. How much cheaper do you want it? That's my thing. And here's the thing. If I buy calls and the price falls, I'll then sell puts to offset the losses in the calls, or at least for an opportunity to recover my calls. Because if it's a 0.9 book right now, if it falls, it's going to be even cheaper. So selling the puts will not be a major disaster if I'm put to stock. So this is my call on Citigroup. So here's a general way of how I would trade these stocks. Again, to recap, I usually like to play next week's earnings to play on this week's sympathy moves. This is Bank of America weekly. It looks extended, but again, if I look at Bank of America, I bet you it'll have the same stats as the other one. 15-ish PE, 1.2, 1.4, 1.5 price to book. So you can see the short-term daily regression line should be higher, but who knows? It's again coming up against a pivot point for Bank of America, and that's why I'd like to trim some profits to have some greens in my pocket, even if I'm going to miss out on some. I don't want to be a pig. They say, you know, if they overshoot higher, they overshoot lower. Somewhere in between lies the truth. Here we are. But if I zoom in, I forget to show you that one. 360 will do it, I think. Okay. So higher lows knocking on a roof line, which end up looking like some sort of a cup and handle thing. So higher lows knocking on a roof. Usually if the roof breaks, they overshoot higher, and this would be the goal I'm looking at. 32. So these are fast candles. How convicted are they? I don't think they have a lot of conviction. It's going to be chutes and ladders. This is, you know, technicians will probably say it's a cup and handle. Usually the upside is about the size of the cup. So any which way you slice it, there's upside potential. All right. Nick signing out. If you have any questions, let me know.